Hello, good afternoon, ladies and gentlemen, and welcome to our webinar. We've got a huge crowd today. I'm Shelley Giordano, founder and chair of the Funding Longevity Task Force at the American College of Financial Services, and I'll be moderating today's presentation. Today's webinar is sponsored by Retirement Funding Solutions, a wholly owned subsidiary of Mutual of Omaha Bank. So before introducing our speaker, I'd like to start with a slide showing you the Funding Longevity Task Force. Dr. Pfau is going to be driving our presentation today. And as you're looking at our picture here at the Housing, Wealth, and Retirement Symposium that we held in April in Washington, you can see Dr. Pfau, he's on the far left there. So as you can imagine, I'm truly honored to be able to share Dr. Pfau's scholarship with you. Actually, we were lucky to get him at all. I suspect it has something to do with Halloween and the fact that his 3 children probably want to trick or treat with Dad. So let's move on to the next slide, please. So as you can see from the next slide here, Dr. Pfau earned a PhD in economics from Princeton. He wears 2 professional hats. He's both a professor at the American College as well as Director of Retirement Research at McLean Asset Management. Next slide. So you can see here, here's an overview of all the accolades and publications and speaking engagements, all of which have contributed to Dr. Pfau's stature in the financial services sector. So you can visit Dr. Pfau at retirementresearcher.com and see for yourself what he's up to, and this includes a course that he's providing, an e-course that he is providing on portfolio distribution. So it's not an exaggeration to say that Dr. Pfau is revered in the retirement security space, and when he talks, advisors listen. So Dr. Pfau, we're going to turn it over to you now, and so you can describe for us what you've discovered about housing, wealth, and retirement. Thank you, Dr. Pfau.
Okay, yeah, thank you, Shelley. Thanks for inviting me, and thanks to RFS for inviting me to do this webinar today. As Shelley mentioned, for the most part, I do research about building retirement income strategies, and I kind of started from the general conventional wisdom about reverse mortgages that didn't seem like they were all that useful of a tool. But Shelley invited me to that Funding Longevity Task Force meeting, one of the earlier ones back in the fall of 2014. So after attending that, and then after getting a stack of articles to read about reverse mortgages, I became really intrigued on the role they can play in retirement. And that's really what this presentation is about. It's to set up this framework about how to think about retirement and the risks of retirement and building retirement income strategies, and then how reverse mortgages can fit into all of that to help create better retirement outcomes. And so just briefly, retirement, the nature of risk changes in retirement. That really, on the one hand, this overarching risk of retirement is longevity risk. It's the idea of not knowing how long the financial plan needs to last. We hope and we plan for long retirements, and long retirements are more expensive. Just every year someone lives, that's another year of their budget they have to be able to finance. And so with a longer retirement, we have to be concerned about that cost. And then it's with the long retirements that other types of retirement risks can also become an issue. These other risks are related to the macroeconomy and financial markets, such as investment volatility, changing interest rates, changes in public policy and tax rules, and then the sequence of returns risk, the idea that once you start taking distributions from the portfolio, it really amplifies the importance of early retirement market returns. And volatility has a much bigger impact, especially in the early years of retirement, after retirement begins and after those distributions begin. So you really need to be thinking about investment volatility in a different way once you start taking distributions from the asset base in retirement. And then inflation, it's a macroeconomic variable, but even a low inflation rate does build up over a long retirement period. And personal spending shocks or contingencies, the potentially large expenses that fall outside of the retirement budget that may or may not happen, but that if they do happen, they require assets not earmarked for other purposes, liquid assets that are available to help fund these types of expenses. So this is how I think about building a retirement income plan, where the goals of retirement are the 4 L's. They're the financial goals on the left, longevity, lifestyle, legacy, and liquidity. And then they map into the liabilities or the expenses associated with those goals on the right. And those are the more core essential types of expenses, and then expenses that may be more discretionary in nature. And then the legacy goal, what you want to leave to the next generation, and also the contingencies or the spending shocks, the potentially large expenses, again, like long-term care, major healthcare bills, and so forth, that fall outside of the retirement budget and that may require additional assets. And so then positioning assets to meet those liabilities, I like to think about assets in 3 general types of categories: reliable income, and the diversified investment portfolio, and then reserve assets. And I mentioned on this chart, home equities listed under reserve assets, just reflecting the conventional wisdom about a reverse mortgage, that you really treat the home as a last resort. You spend other assets, and then if everything else fails, you might finally consider a reverse mortgage as a way to tap into home equity to be able to help meet expenses with that asset. But otherwise, you leave it in the background as a reserve. Well, the whole role of a reverse mortgage and the home equity conversion mortgage program is that it provides a way to treat home equity not just as a reserve asset, although it can certainly help in that regard, as I'll discuss as well, but to potentially treat it as with a 10-year payment, that ongoing monthly payment. You could treat it almost like a reliable income asset. You could also conduct portfolio coordination strategies where you treat the reverse mortgage as a buffer asset that it works with the diversified portfolio and almost becomes part of that diversified portfolio. Or you could open the reverse mortgage and treat it as a reserve for contingencies later in retirement. So how do we manage these types of retirement risks? And it's really this combination of the sequence of returns risk and the market volatility and how that interacts with the longevity risk. If we live a very long time and we get poor market returns, how do we manage these risks? Well, there's really just 4 ways to manage this type of risk. The first is to spend conservatively from an investment portfolio. And then I'll just mention in some cases where a reverse mortgage can help with this, and that's helping to cover some of the spending so that you can take a smaller distribution from the investment portfolio. The whole logic of things like the 4% rule of thumb is just, let's figure out how low spending needs to get so that we don't deplete the investment portfolio. Well, reverse mortgage may help you to reduce the distribution you need from that investment portfolio to meet your financial goal, and can then therefore help to extend the longevity of that portfolio. So options where a reverse mortgage could help with conservative spending from an investment portfolio, that 10-year payment I mentioned, the ongoing monthly income, refinancing a traditional mortgage at the start of retirement so that you're not carrying that large fixed expense of mortgage payments in the early years of retirement when you're more vulnerable to market volatility. And then also potentially delaying Social Security, which has shown to have a lot of value. And if you're already retired before you begin claiming Social Security, potentially using a reverse mortgage to build a bridge and to support Social Security delay. The next set of ways to manage sequence risk, and in this regard, a reverse mortgage isn't necessarily helpful in that category, but it's spending flexibly. If you can reduce distributions from your investment portfolio after a market downturn, that helps to manage sequence risk. It helps to avoid selling assets at a loss. It helps to extend the portfolio's longevity in retirement. But that requires reducing spending. And so there's no role for the reverse mortgage. With this strategy, you're just simply reducing the amount of spending. Well, later we can see how a reverse mortgage may help you to not have to reduce spending. The third category is to reduce volatility, also not necessarily a role for a reverse mortgage there. Reducing volatility, it doesn't mean just simply investing in bonds and so forth, because that's part of the issue that you get into. The basic rules of thumb around retirement call for pretty aggressive stock allocations. As soon as you want to spend more than bonds can safely support, bonds are just going to ensure that you deplete your portfolio. And so reducing volatility doesn't necessarily mean going into bonds. There's other strategies here about just changing to a lower stock allocation when you're the most vulnerable, or using lifetime income protection through things like annuities as a way to pool risk and get a bond-like return, but also with the power of knowing that you would receive this subsidy from the risk pool if you live beyond your life expectancy. And then the fourth option, and again, this is really a complete list of ways to manage these retirement risks. The fourth approach is called a buffer asset. It's an asset outside of the investment portfolio that's not correlated with the investment portfolio that you can draw from on a temporary basis when the portfolio is down, and that gives your portfolio more opportunity, we hope, to recover, not having to sell those assets at a loss to cover spending, to then be able to continue later to take distributions from the portfolio. And the buffer asset provides that gap. So there's three buffer assets that are out there. In the 1980s, Harold Ivinsky really got that discussion started with a 5-year cash reserve that he talked about. Have 5 years of expenses in cash, and then if the stock market's down, you don't have to sell those stocks. You have up to 5 years for the portfolio to recover again. You can spend from that pile of cash. Well, with interest rates being so low on short-term type assets, they have been coming up a little bit recently, but they've been low for a long time. Cash has fallen out of favor. And so the two other buffer assets are the cash value of permanent life insurance is also discussed in this context. And then starting in about 2012 with Barry Sachs research, he explained how you could also use a reverse mortgage in this way. And that's really been where most of the research has applied, using the growing line of credit on a reverse mortgage as a way to treating it as a buffer asset to coordinate spending with the investment portfolio, where if markets are down, you spend from the reverse mortgage. If markets are up, you resume spending from the investment portfolio. And that, again, it's a way to avoid selling portfolio assets at a loss. So that's where a lot of the research is applied. I'll mention that research a little bit later, but I'll also talk about how with the change in the rules for the reverse mortgage program last October, even though most of the research has been about the buffer asset approach, it's always been the case that refinancing a mortgage has been the most popular use. And that strategy can actually make a lot more sense today under the new rule framework we've had over the past year. So uses for a reverse mortgage. These are 4 general categories of ways to use a reverse mortgage that vary the uses from, on top of the table, it's uses that tend to use the reverse mortgage more quickly, spend down the home equity more quickly near the top of the chart. And then as you go to the bottom of the chart, it's uses where you may open the line of credit, but not necessarily use it, or use it more slowly over time. And so from the top, the first category is coordinating with housing debt in retirement. And that's been the most popular use in the past, refinancing a traditional mortgage, not carrying those fixed mortgage payments and having to make those payments in the early years of retirement, but delaying that repayment until later in retirement. Transitioning from a traditional mortgage to a reverse mortgage, which is much of the same concept, but what I mean to distinguish here is you can voluntarily make payments to pay down the loan balance on the reverse mortgage. And with this second strategy, if markets are doing fine, you continue to voluntarily pay down the reverse mortgage loan with the same amount that you would have paid on your traditional mortgage. But you have the flexibility that if you are getting hit by a negative sequence of market returns, the traditional mortgage doesn't let you skip a payment. But if you're voluntarily making these repayments on a reverse mortgage, you're more than welcome to not voluntarily make those payments at that time. And so you have the flexibility there. Also, a lot of Americans would like to age in place, and doing that may require some expensive home renovations. Wheelchair accessible entrances, having a bathing facility or a bedroom built on the first floor of the home, all kinds of things that a reverse mortgage could potentially help to fund those renovations to better support aging in place and to people stay in the home that they want to stay in for longer than might otherwise be feasible if the home just is not remodeled in the necessary ways to allow for that sort of aging in place to take place. And then a final category here is the HECM for Purchase program, in which a retiree after age 62, someone moving to a new home, can potentially finance a portion of the cost of the new home through a reverse mortgage, rather than potentially either paying cash for the home and reducing the portfolio balance and therefore increasing the distribution rate to meet other spending goals, or carrying a traditional mortgage into retirement and having that higher fixed expense to pay those mortgage payments. Now, the next category is coordinating the investment portfolio with the reverse mortgage to cover retirement spending. And some of the potential strategies here include, well, you could spend home equity first to give that portfolio more opportunity to grow. This would be the riskiest of these strategies in terms of it's making the assumption that the portfolio will grow in those intervening years while you're spending down home equity, so that you're going to be able to better support your retirement later when you begin taking portfolio distributions. And then if markets are not cooperating, you've spent down your home equity without necessarily getting the portfolio into a better position. But the second category, we're getting more, moving away from that riskier approach, would be to just simply coordinate. Sometimes you spend from the portfolio, sometimes you spend from the reverse mortgage. That's the two main strategies there are the original strategy that Barry Sachs and his brother recommended, which is the case that if the markets were down in the previous year, you spend from the reverse mortgage. And if markets were up in the previous year, you spend from the investment portfolio. This is also where what I call the Texas Tech strategy fits in with Harold Avensky and John Salter and Sean Pfeiffer at Texas Tech University. They build a glide path for retirement and chart out to meet your financial goals. This is how much wealth you would need every year in retirement. If you have more than that, you spend from your portfolio to meet expenses. If you're falling short, and they figure out you can even fall short a little bit, but if you fall below 80% of the threshold of where you project you need to be at that point, then you start spending from the reverse mortgage as a way to fund your ongoing retirement expenses. And also you could consider the 10-year payment option here, which is an ongoing monthly payment for as long as the household remains eligible for the reverse mortgage. Now, the third category is funding sources for retirement efficiency improvements. And these are matters where, as I mentioned at the beginning, we hope and we plan for long retirements. Long retirements are more expensive. Sometimes there's actions you can take that may increase costs in the short run, but by doing so help to ensure much better, more efficient long-term outcomes. And with a short-term expense, the reverse mortgage could potentially play the role of helping to fund that short-term expense to set you in motion to then have a better long-term outcome for that retirement. And so some of the possibilities here, well, annuities with lifetime income guarantees can provide great value in pooling risk and in competing with an investment portfolio in retirement, but they require an upfront premium to be paid for that income protection. A 10-year payment on a reverse mortgage has a lot of the same features as a simple income annuity, except that you don't have to pay a premium out of the investment portfolio. You just spend the home equity as each monthly check comes in, and that allows you to get the benefits of having that protected income without having to reduce your portfolio value in order to be able to do that. As I had mentioned earlier, building a Social Security delay bridge. For many households, delaying Social Security can be a very helpful and beneficial outcome. But you miss benefits until you may skip earlier benefits to get larger benefits later, and you have to fill that gap somehow. You don't necessarily want to use a higher distribution rate from the investment portfolio while you're waiting for Social Security to begin, because that would increase your exposure to sequence risk by having you use a higher withdrawal rate in those key early years. A reverse mortgage could be used to fill that gap, that missing Social Security benefit that you've given up for a few years in order to get the better long-term outcome. Well, you could take that from the reverse mortgage and still have that spending power. And then there's a lot of tax-based strategies around getting better longevity from an investment portfolio, having a more efficient retirement outcome, managing the role that required minimum distributions will later play in potentially pushing retirees into higher tax brackets if they have too many assets in their tax qualified plans. While distributions from the reverse mortgage do not count as taxable income, they're not part of the adjusted gross income, and so they're not going to affect your premiums on Medicare or your tax bracket and so forth. So you might fill in some spending holes from the reverse mortgage in that regard. Or more generally, you might be thinking about, especially if you're delaying Social Security and you're already retired in your 60s, it can be a great opportunity to do Roth conversions, to move some of those assets from the IRA into a Roth IRA while you're in a lower tax bracket to avoid after age 70 and a half when the required minimum distributions kick in, having that push you into a higher tax bracket at that time. And you could potentially use the reverse mortgage to pay those tax bills. And then a final use here, if a client or an individual has a traditional long-term care insurance policy, chances are the premiums have been going up. Those policies were not priced correctly. They can be very beneficial and so worthwhile to keep, even in spite of their premium hikes. But the premiums have been going up, and perhaps the reverse mortgage can provide a way to continue to make those payments for a policy you've already had so that you don't have to lapse on that policy in the event that premiums have been coming up. Or so you don't need to think about lapsing on that policy, which may otherwise then happen at the worst possible time after you've been paying premiums for years, and then perhaps shortly before you might actually get value out of the policy. And then the final category is to preserve the credit of the reverse mortgage as a potential contingency fund or insurance fund to cover unprotected or unexpected expenses in retirement. And here the value can relate to opening the reverse mortgage early and letting that line of credit grow, and then it will generally grow to be worth more than if you wait until later to open the reverse mortgage. And so some of the potential uses here: opening the reverse mortgage, letting that line of credit grow, and then using it to support spending after the portfolio depletes. Setting up that line of credit as a way to protect the value of the home. If there's a significant market downturn for home values after you've set up the reverse mortgage, you can get into the situation where the line of credit could exceed the value of the home. Or just setting it up as a contingency fund where you have this growing line of credit to help cover spending shocks, in-home care expenses, significant health expenses. If the household gets divorced, it can be a way to split the home equity and not necessarily then have to sell that marital home and so forth. So it's also important to consider about how reverse mortgages work. I'll try to get through this part quicker, as I think maybe the audience is for the most part going to be more familiar with that. But so I'll go through this part more quickly to get into uses for the reverse mortgage in more detail. And so reverse mortgages have had a negative image. The media coverage really has done a 180 in that regard. But we still see this misconception that Shelley always likes to note that it's very unfortunate. It's hard to break this idea that people have that you lose the title of the home as part of a reverse mortgage. And for the home equity conversion mortgage program, that was never true. And then in the old days when there was negative media coverage, it was just often based on family misunderstandings where the retirees decided to spend the home equity on themselves and their children thought it was going to be left for an inheritance and so forth. And it just gets into a convoluted mess. But some of the past problems have been corrected. Now the protections for non-borrowing spouses, now the financial assessments to help keep out desperate borrowers from using and trying to improve the mortgage insurance fund and so forth to protect taxpayers from the having to make due on some of the guarantees that the reverse mortgage provides and so forth. Nonetheless, we still have the stigmas related to the direct-to-consumer TV commercials, and then also the stigma about a retiree not wanting to go into debt. The structure of a reverse mortgage, technically it is a debt, but I really like to frame it more as a way to spend down home equity in the same way you would spend down an investment portfolio. It is technically debt, but it's not a debt that has a fixed ongoing repayment obligation like we usually think of with debt. It's an obligation that does not necessarily become due until much later in retirement. And so it's a way to think about, just like if you spend from your investment portfolio, those assets are gone for future use. Well, a reverse mortgage gets you a way to spend home equity, and then that asset is gone for future use, but you're spending it. In terms of eligibility requirements, 62 or older, you need to have equity in the home, but you can refinance a mortgage as part of that process. You have to go through the financial assessment to cover your homeowner obligations, have to go through the counseling session, need an FHA, a home appraisal. It's only for primary residences. And then as of this year, the lending limit is on the first $650 of the home value. And then some of the essential jargon around this relates to the principal limit, the expected rate, and the effective rate on a reverse mortgage. So the expected rate and effective rates are the kind of the parameters you're using. The expected rate is to figure out the initial borrowing capacity from the reverse mortgage, or primarily what the initial principal limit factor will be, and that's generally going to be linked to a 10-year interest rate, like a LIBOR swap rate, and then a fixed lender's margin that would be decided upon between the borrower and the lender that remains fixed throughout the period of the loan. And that's to set up the initial borrowing capacity. Then the effective rate is the ongoing variable rate on how the principal limit will grow throughout retirement, which links as well to how the loan balance will grow and how the line of credit will grow throughout retirement. And two of the factors in the effective rate are fixed. The lender's margin, same one as in the expected rate. It's determined at the initial time the contract is signed. And then now, after October 2nd of last year, the ongoing mortgage insurance premium is 0.5%. And then the variable component is just a short-term interest rate, often a 1-month LIBOR rate, but could also be linked to Treasury bills in some cases. So just an example, if the 1-month LIBOR rate is 1.25%, the 10-year LIBOR swap rate is 2.25%, and a lender's margin is 2.75%, then the expected rate is 5%, and the initial effective rate, which that short-term rate will vary over time, but initially it would be a 4.5% initial effective rate, which would mean that anything borrowed would be growing at 4.5% interest. The factors that determine the initial borrowing capacity, or the principal limit factor, which is the percentage that you then apply to the appraised home value up to that lending limit, it relates to your age and your and interest rates, the expected rate. Higher interest rates mean less borrowing capacity. So this can be an advantage of reverse mortgages in a lower interest rate environment. It's a present value calculation. With a lower interest rate, you have a higher present value. The idea is the home is the collateral that will be used to repay the loan balance. And you don't want the loan balance to exceed the value of that collateral. So with lower interest rates, you can borrow more because it's expected that the loan balance would grow more slowly over time. And so from this chart, you can see at lower interest rates, you have a higher initial borrowing capacity. And then at higher ages, you have a higher initial borrowing capacity. But the interest rate effect can potentially be a lot stronger than the age effect, so that if interest rates increase a little bit, you can see how it could take potentially quite a long time before you get old enough to then have the same principal limit factor as when interest rates were lower. And so that can help to provide a motivation of thinking about the reverse mortgage, setting it up in a lower interest rate environment. And this is now kind of part of the presentation. We're a year removed from the rule changes, but the principal limit growth was really more exciting to some extent before the October 2nd rule change. If you were thinking about that as a line of credit growth, Now, if you're thinking about principal limit growth as a loan balance growth, the new rules make it more exciting because now the loan balance will grow more slowly. But in the old days, well, today now, it also means the line of credit will grow more slowly. So what is being compared here, the dashed line was showing how in the initial version of this presentation before that rule change last year, the line of credit or the principal limit grew at a much faster pace and surpassed the value of the home at about age 83 than with the more solid colored, cyan colored curve, the line of credit or principal limit growth under the new rules, still growing, still catching up to home value, but at a much slower pace than under the old rules. Now that's the line of credit growth, but that's also loan balance growth. If you're refinancing a traditional mortgage, it means your loan balance is also going to grow more slowly. And that's being driven primarily because the ongoing mortgage insurance premium is lower than it used to be. It's now 0.5% instead of 1.25%. Now, I've been talking about line of credit growth, and that can be one of the key issues that's hard to understand and that can seem too good to be true. And so it's worth just spending another minute to discuss that concept. There's something called the principal limit. That's the borrowing capacity of the reverse mortgage. The initial principal limit is just what percentage of the home value can you borrow. And that's always going to be equal. The equation you see here is always true. The principal limit is always equal to the loan balance plus the line of credit plus set-asides for the financial assessment. But that's usually small, and we can just ignore that to make this even easier conceptually. Principal limit is loan balance plus the line of credit. That's always true. All three of those factors grow at the same rate. So if you've borrowed something, it's always going to be growing at that factor. If you've got line of credit, the ratio of loan balance to line of credit will always stay the same. Everything's growing at the same rate. Now, if you borrow from the line of credit, you move some of that over to the loan balance, you have a new ratio between the two, but then they always grow at the same collective rate. And if you voluntarily repay some of the loan balance, you move some of it from loan balance back into line of credit, you have a new ratio between the two, but then they're still always growing at the same rate. And policymakers, for the most part, probably thought people would use reverse mortgages because they want to borrow from them. So principal limit growth, if it's all loan balance, it reflects loan balance growth. The interesting planning implication, and that's what Barry Sachs' research was pointing out, how you could then treat this as a buffer asset, is if you open the reverse mortgage and you keep a low loan balance, you have to keep a nominal amount in the loan balance to keep the loan open. But if you otherwise mostly treat it as line of credit, then it's as though the line of credit is growing at the same rate as a loan balance would grow, but it's not a loan balance. It's a line of credit. And it's a line of credit that can continue to grow and at some point get to levels potentially even close to the value of the home. So this is just comparing if you open the reverse mortgage at age 62 and let the line of credit grow and interest rates never change, that's that cyan colored curve. You can see it's growing faster than the yellow colored curve, which is if you waited until each subsequent age to open the reverse mortgage. If you wait, you get to borrow more because the chart here shows how the home value is growing over time. So you get as an older person, a higher percentage of a growing home value. So the yellow line is growing, but opening the reverse mortgage right away at age 62 is allowing for more line of credit growth than the line of credit you would get by waiting to open the reverse mortgage. Now, admittingly, this chart was more impressive before the rule change, where, as you recall, that dashed line got you so that the line of credit exceeded the home value by age 83. It's not quite as exciting now, but if we still think about this in the context of a low interest rate environment, here's what happens if just simply at age 62, we open the reverse mortgage or we don't, and then sometime in that first year, we see a permanent increase in interest rates by 1%. Well, the cyan-colored curve is now growing at a much faster clip because now that variable interest rate component is 1% higher forever. And the yellow curve drops because now with interest rates permanently 1% higher, all the future expected rates are going to be less than they would have otherwise been. And so here, that gap between the cyan curve and the yellow curve is a lot more impressive. It really reflects the value of opening the reverse mortgage before you might potentially need to use it as an asset in retirement so that you can get that line of credit growth process begun. Low interest rates do favor the home equity conversion mortgage program by helping to support a larger initial principal limit, and then also to the extent that interest rates might rise in the future, helping to have that accelerated growth for the line of credit and the principal limit. Now, with spending options on a variable rate HECM, you can take out a lump sum, you can set that term payment, which is an ongoing payment for as long as the household remains eligible for the reverse mortgage. A term payment is a payment for a fixed number of years, and the household needs to remain eligible to get the full period covered by the reverse mortgage. Or you can use a portion as the line of credit to draw from in an ad hoc manner as you wish. You can also set up a modified term or 10-year payment with a portion of the principal limit. Now, I want to talk in more detail about a few of these applications to finish up, and then we can open for some Q&A at the end of this. The most popular way reverse mortgages have been used in the past, and a way that has been potentially improved or made better by the new rules since last October, is to refinance a traditional mortgage into a reverse mortgage. Today, there's a 2% upfront mortgage insurance premium for setting up the reverse mortgage. This is an area where the line of credit growth strategies were hurt, because if you're just using a line of credit growth strategy, that initial mortgage insurance premium was 0.5% before, so it increased from 0.5% to 2%. But if you were refinancing a big mortgage in retirement, such that you were having to use more than 60% of the initial principal limit borrowing capacity to refinance the mortgage, then actually your initial mortgage insurance premium decreased from 2.5% down to 2%. And as I mentioned, with the reduction in the ongoing mortgage insurance premium from 1.25% down to 0.5%, the loan balance grows more slowly now as well. So this strategy, again, potentially has been strengthened by the new rules that are in effect. And this has been the most popular way to use a reverse mortgage. So just to show an example of this is a short case study that we can allow us to compare different strategies. So we've got a 65-year-old couple. They're entering into retirement. 20 years ago, they purchased a $300,000 home with a 20% down payment. And 20 years ago at that time, a 7.5% fixed rate 30-year mortgage was kind of the mortgage rates at that time. 5 years ago, they refinanced that remaining mortgage balance into a 3.5% fixed rate 15-year mortgage. So now, as they got to retirement, there's 10 years left on that mortgage. They have annual mortgage payments due of $15,574. And now with 10 years left on the mortgage, the remaining balance is $129,526. Now the home value grew at 3% a year for the past 20 years. So it's worth $541,833 today. We look at the numbers I showed earlier about examples on where interest rates are and the lender's margin. It's what I used in this example as well. So with those parameters, the initial principal limit is 45.9% of the home's appraised value, or $248,701. Now, to set up the reverse mortgage, I'm assuming the full retail pricing. I'm not giving any sort of discount here to try to make that case stronger for the reverse mortgage. The full retail pricing is being charged, and that's $6,000 for the origination fee, $10,837 for that 2% mortgage insurance premium, and $2,500 for other closing costs. So if this is going to add value to the financial plan, it has to do so despite a more than $19,000 cost to set up the reverse mortgage. Now that can give people sticker shock, but just keep in mind that the results I'm going to show if the reverse mortgage is helping, it has to be net of that upfront cost. So we open the reverse mortgage, we finance the upfront cost, we refinance their mortgage. That has to be done as part of opening the reverse mortgage, so that remaining mortgage balance. And then that leaves a line of credit afterwards still of $99,839. And we're going to then let that line of credit grow and use it to continue to support retirement spending in the event that the investment portfolio depletes later in retirement. And then we do Monte Carlo simulations on the household wants to spend at a 4% post-tax rate, which is actually a higher pre-tax rate. They have $1 million in an IRA. The home is worth $541,833, and I assume they're in a 25% marginal tax rate, which used to be a federal bracket. It's no longer a federal bracket, but if you live in Pennsylvania like myself, where there is a 3% state income tax, that would be a 22% federal tax bracket with a 3% state income tax bracket. And we're looking at, for retirement lengths of up to 40 years, what's the probability they can meet any home payments, plus meet the spending goal for retirement and pay taxes on their IRA distributions using different strategies with how they incorporate home equity into their retirement plan. So the two purple curves on the top of this chart are giving you the highest probabilities of success. So that means they're helping to sustain retirement. And again, this is net of the fees to set up the reverse mortgage. So the strategy that's giving the most improvement to success rates is to refinance the mortgage into a reverse mortgage and voluntarily make those repayments so that you continue to pay down the what the mortgage payment would have been in years when markets were up, in years after markets were up. But in years after markets were down, you skip those voluntary repayments. And you do that so that you can reduce the loan balance, move some of that back into the line of credit, which then feeds into greater line of credit growth so that you have a bigger pool of funds in the event that you deplete the investment portfolio, which, to be clear, is quite possible because on a pre-tax basis, we're talking about a 5 1/3% withdrawal rate, which is well above the quote-unquote safe withdrawal rate for an investment portfolio in retirement. You can see that they're really spending too aggressively because after 30 years, there still is just a little bit over a 60% chance for success. They really should be considering reducing their spending in retirement. But nonetheless, the refinancing the traditional mortgage gives them the best opportunity at meeting that spending goal. And then the second best approach was to refinance the traditional mortgage and just don't make the voluntary repayments. Then you don't have as big a pool in the line of credit when inevitably at some point that investment portfolio depletes. And then the two strategies that didn't work as well are, I looked at, well, you could just pay off the mortgage at the start of retirement and those fixed payments by taking that from the investment portfolio. And you don't really use the reverse mortgage except as a last resort when the investment portfolio depletes. Or you just keep the mortgage in retirement. You pay off the mortgage payments for 10 years, and then it's done. That goes on top of the 4% post-tax and post-mortgage payments spending goal that you have in mind. And then you also just treat the reverse mortgage as a last resort. So refinancing a mortgage into a reverse mortgage, you can see has noticeable effects on improving retirement sustainability. And it can also do that without hurting legacy as well. This is legacy values on average over that retirement period. And legacy value is calculated as whatever remains in the investment portfolio plus the value of the home minus the loan balance on the reverse mortgage that needs to be repaid. And the reverse mortgage strategies, well, you can see really they slightly increase legacies, but it's hard, not by a whole lot. The point is really it's not hurting legacy. It may even slightly help legacy in the average outcomes after also helping to increase retirement sustainability. And then you can also see that in that around year 33 to 35, where that legacy curve gets flat at 0 for a little bit, that's the non-recourse aspect of the reverse mortgage kicking into effect, where your line of credit, you may be able to spend and have a source of retirement spending, but there's no offset to the legacy value because already the borrowing capacity has the loan balance has exceeded the value of the home, and so there's no offset to legacy. The loan balance that must be repaid is capped at 95% of that appraised home value at that point in retirement. So you do get that little bit of a kicker there, where legacy values are strengthened as well by some of these reverse mortgage strategies. There is a HECM for Purchase program as well, and I just have a scenario that tells very much the same sort of story, looking at someone wanting to buy a home at the start of retirement. I won't go through all these details so that we have a little Q&A time, but again, charging full retail costs on the reverse mortgage, and then again showing this idea that the strategy which creates the most improvement to retirement sustainability is to use the HECM for Purchase and make voluntary repayments on that loan balance. The strategy that works second best is to take a traditional 15-year fixed rate mortgage, but then, and you can't open the reverse mortgage and have a traditional mortgage, but then at the end of 15 years, open that line of credit and let it start growing. And then the worst strategy, that yellow dashed line, is you pay cash for the home, reduce the size of your investment portfolio, increase the pressure on distributions from the portfolio, and you only treat a reverse mortgage as a last resort option when the investment portfolio depletes. Now, the types of mortgage uses I've been describing are most popular in practice and have in a lot of cases been strengthened by the rule change last year in October. The portfolio coordination strategies are where most of the research has been focused and were not strengthened by the rule change last October. But there can still be value here. And this is, as I mentioned, in 2012, there were two different research articles that really had the same thesis. They approached it in a different manner, but they started from the same thesis that the strategic use of a reverse mortgage standby line of credit can create retirement income efficiencies through its contributions to managing sequence of returns risk in retirement. So this is really just an extension of the research about Harold Avinsky's original 5-year cash reserve philosophy, and also the way that the insurance industry talks about using cash value as that sort of a line of, not a line of credit, a standby asset, a buffer asset that can be used to help manage sequence of returns risk in retirement. And so applying those concepts to the reverse mortgage. And so there's different strategies we can look at with that. But the story that comes out, and this has all been updated under the new rules. So under the new rules, the two coordinated strategies offered by the Sachs brothers and the Texas Tech professors really give you the best chance at improving retirement longevity. In this case, you don't have a mortgage at retirement. You're trying to meet a spending goal for as long as possible and looking at different ways to coordinate home equity with the investment portfolio. And those true coordination strategies do give you the most sustainability for that retirement plan. Without hurting legacy, and in fact, potentially even helping legacy with those portfolio coordination strategies going out to those longer retirements. They are the highest, not by a lot, but they are the highest. So they're not hurting and maybe even helping a little bit legacy goals. So the whole media misconception around you're spending your kid's inheritance, it's not true. It's because money's fungible. Yeah, the home equity piece may be smaller, but by helping to manage sequence risk, the investment portfolio is larger. The net legacy is the investment portfolio plus the home value minus the loan balance. And though the loan balance offsets some legacy, that's more than counteracted by helping to have those synergies to keep the investment portfolio in place and not to help manage avoiding depletion for it, leading to a bigger overall legacy. So not actually hurting the kid's inheritance, but helping the kid's inheritance after the goal is there to meet a particular spending level throughout retirement. So to conclude, the conventional wisdom around reverse mortgages hurts retirement sustainability. They shouldn't be treated as a last resort option. They can add more value by being thoughtfully incorporated earlier as part of an overall retirement income plan. Strategic use of the home equity conversion mortgage can improve retirement sustainability and support a larger legacy. It works through its ability to help mitigate sequence of returns risk and through its value in providing that growing line of credit. Unlike most every other retirement income strategy, low interest rates actually help the home equity conversion mortgage. That's usually low interest rates make everything more expensive. But with reverse mortgages, because of that present value calculation, you get that bigger borrowing capacity. And this is a strategy that's going to be more helpful for the middle class retirees or the mass affluent retirees rather than those with high net worth, because it's just because of the lending limit on the home value, that asset value, that $671,000 potentially asset value, is a bigger overall portion of their assets, and therefore gives them more overall value. So responsible use of the home equity conversion mortgage program can improve retirement efficiency, and it's really a worthwhile tool to consider with clients and their portfolios and their overall using their asset base to meet their retirement liabilities in a more effective way. So thank you very much for your attention, and thank you, Shelley. This is a picture of a book I wrote about reverse mortgages. If you type in reverse mortgages at Amazon, it'll be the first book to come up. Usually the second edition shows up before the first edition, but just make sure it says second edition at top, because I rewrote it after the rule change. The rule change last year was so significant, it required a full rewrite of the book. Thank you, Shelley. I'll hand over the floor to you now.
Well, a couple of minutes here for questions. We've got quite a few here, so I'm going to bunch them up a bit. Could you speak about the FINRA position on reverse mortgages? My broker-dealer prohibits us from talking about reverse mortgages when doing retirement income planning and blames FINRA.
Mm-hmm. So FINRA developed a really clever title for a report, and right now I don't. So it's reversal of fortune, right? Reversal of fortune, how a reverse mortgage fits into the retirement. They thought the title was so clever, they never changed it. It sounds negative, but they have changed the text of the FINRA report. If you actually read that reversal of fortune document that FINRA prepared, it's not so negative. It's not negative about reverse mortgages. It has things to be careful for. It explains things that I would also agree with. There's a cost involved and all that sort of thing, and it's not for everybody, but it's not negative anymore. It used to say, use a reverse mortgage as a last resort option, but after Barry Sachs convinced them that was the worst possible way to use a reverse mortgage, they took that language out. And though the report is measured and says, just be careful with a reverse mortgage, it's not at all negative, not like the title implies. So the compliance department should reread that FINRA report and judge for themselves if FINRA is really telling them not to use reverse mortgages.
We're blaming FINRA. Let me put a couple of these questions are here. Oh, do you know of any commercial software that will allow you to model these strategies that you presented?
The coordinated strategies, I have to write my own programs to do most of this because it is too complicated for commercial software. I work with a software company, InStream Solutions, and we're working on building some reverse mortgage tools. I know that Money Guide Pro is one of the popular programs out there, and they've incorporated some reverse mortgage tools, but there's not really a way to model coordinated strategies in commercial software. You can definitely model things like refinancing a traditional mortgage and so forth, because that's all just changing cash flows. So that should be possible.
Right. So here's another question, Dr. Pfau. For someone in a higher tax bracket, are the HECM coordinated strategies substantially better after taxes?
Well, yeah. And in that regard, the higher the tax bracket you're in, the more important the tax benefits are from the reverse mortgage because it's keeping you out of that higher tax bracket, or it's letting you do Roth conversions at a lower tax bracket. The biggest impact is just where you get from where it jumps from 12% to 22%. I think those are the right numbers for this year's tax rates. But that's where there's the biggest change in tax brackets, where you'd get the most value. But certainly it can have value at higher tax brackets as well. You just have to also think about at the higher tax brackets, that household probably has more assets. And then we get back into that discussion how, relatively speaking, the principal limit on the reverse mortgage is not such a big percentage of their assets. It can still add value, but just relatively speaking, less value, but can still be worth looking at.
Well, we have a few more questions here, but for the sake of time, we will distribute these questions and make sure that we answer them. And quite a few suggestions that we send out, the link and the PowerPoint, which of course we will make available to you. So having said that, just a couple more slides here. I hope what everybody was able to take from this Dr. Pfau's presentation, two major concepts are, if you're thinking about a reverse mortgage only as a last resort, you're not keeping up with the research. Probably the worst way to use a reverse mortgage is to hold it and hope and pray that such a thing will exist 20 or 30 years down the road. And the second concept, that the reverse mortgage can really serve as a giant liquid shock absorber. And what might be different about thinking about shocks coming in retirement, and there's so many of them, divorce and things to do with your house and your car and your health, inflation shock, all of those big unknowns. The real contribution to the science here was that you could look at a reverse mortgage as a shock absorber when the portfolio is temporarily undervalued. So, the sake of time, we're just going to have to stop here. So, thank you so much, Dr. Pfau. This was really interesting and thorough. We appreciate it, and thank you for joining us today. And please watch for the next webinar in our series. Thank you.
Yeah, thanks, everyone.